why risk matters and a way to control your risk management investment decisions. We want to decide how to manage risks in trading. Here are some of the steps I utilize in my trading process. I think that everyone should start by deciding your own time frame, selecting and sticking to a total equity risk value, and look for higher probability setups, all while utilizing a proper position sizing. So we'll discuss a few of these here. So deciding your time frame, the first thing you want to do is decide on what type of trader you are. Are you a day trader, a swing trader, a long-term trader? Each have their own pros and cons, advantages or disadvantages. And what you want to do is you want to sit there and decide that, am I more of a day trader? Am I more of a swing trader? You don't want to jump in between all of these and find yourself not really sticking to a specific method. If you do decide that you're a day trader, your best way to work is by utilizing a different chart setup. So you probably want to use shorter time frames like a 5-day chart, minute charts, hourly charts. Whereas swing traders should probably use more of a daily chart over a longer period of time. That's not necessarily the best method, but it does happen to work out best for most people. Long-term investors, you're best looking at your weekly and monthly charts, looking for those to trigger because that can actually lead to very large long-term moves in your favor. When you decide on your total risk value, you need to stick with a few rules of thumb. I like to sit with a 1% of total equity at risk. So usually I never go above 2%. This allows me to keep myself from blowing up my account too quickly, putting far too much risk on in a trade that doesn't dictate that I should. It's always easier if you're losing a lot of money to just reduce that number. So I know recently I had gone through a losing streak, so instead of 1% I bumped it down to 0.75%. One last bit here is you should never average down on losing stocks. There is an exception to this in which you want to maybe see, is my trading philosophy invalidated? If it's not, then you can add to a position and kind of bring down that average cost. But as an overall theme, I only do that if it's some of the best setups that I've looked at. As far as setups, your higher probability setups should probably stick to certain criteria. So you shouldn't enter a trade unless you're going to at least get a 2-for-1 return. I know Paul Tudor Jones says he sticks to 5-to-1. So I found that I had a hard time finding 5-to-1, 4-to-1. So I started with 2-to-1. I've worked my way up to finding better setups that give me about a 3-to-1 return to risk ratio. Some of these setups I found were close to their support levels, their resistance levels. So if you're going to be a breakout trader or a support trader, you're going to short at breakouts, whatever it may be, you want to stick to that method. I know that my number one strategy in working has always been with breakouts and buying the 200-day moving average cross. So when price crosses above it, I can get into it. By doing this over and over and over with defined risk, I'm getting a slight edge in the markets that allow me to make money in the long term. Sometimes you might go through periods that nothing's working, but then eventually when it does, you end up making more than you have lost in those other periods. Longer term trends tend to be more sustainable than a short term move. So if you're looking at charts, you should probably set your higher probability setups with stocks that seem to have been on the rise for a longer period of time than the ones that may have just had a sharp move. I don't like to chase aggressive moves in stocks. So I know there was an example, DRYS, Dries Shipping, I believe it was, where they went from $5 a share all the way above $100 a share in a couple of days, and then it crashed right back down to where it was because there was such a short amount of float in the amount of stock being traded. But then there were people shorting the stock that had to cover, so it just created an aggressive move. People make money on those, but typically myself, I stick away from those. I just think they're not worth the risk when there are better setups out there that people aren't paying attention to. The reason you don't want to be the one that's late to the party. So another thing you want to do is you want to utilize proper position sizing. Um, I I found that when I was going all in on stocks, thinking I was knowing more than the market, I was blowing up my account fairly quickly. When I decided to finally utilize this risk formula down here is when everything eventually worked in my favor. So once I set stop losses immediately entering a trade and never moving them unless they justified being moved, that was a big time help. Um, I only like to move my stop losses if I've solidified a gain. So usually I wait for about anywhere from 15 to 25% move in my favor to set it to break even, because a lot of those moves will come retest my break even point before they end up going further along. A good example recently was I was in CZZ. It's a sugar company, and when I entered in around the $7 range, and it immediately went up about 7.30, but came right back to my level. And had I moved too soon, I would have been out of the trade. Well, since it's popped up close to $8 a share, I'm still in it, gonna watch it and let it run. That allowed me to continue to catch that move. So don't adjust those stops, but when you do decide that you want to start risking into positions, how should you size them? At the very bottom here, we have our formula. It's buy price minus stop price equals like the value divided by total equity risk times a percent risk. So if you're sticking to that 1% risk formula idea, say you're buying a stock at $5 a share, you think that you should be out of it if it hits about $4.50 a share. This varies, but it allows you to decide that, okay, that's a 50-cent difference between my buy point and my exit point. Say you have $10,000 account, you're going to take that $10,000, multiply it by your 1% risk, so you're willing to lose $100 on this position. The number of shares you would purchase then would be your $100 at risk divided by the spread of 50 cents, giving you 200 shares. That has saved me tons of money. I know that when I first started trading and I lost about half my account because I wasn't using this formula, once I found this formula and started utilizing it for my moves instead, I was able to recover all of my losses immediately, which was very fortunate, but at the same time, it made me open my eyes to realize that risk management is the most important aspect to trading. So that's it today. If you're wanting to join us or get into our YouTube channel, we have a Twitter account, YouTube, Facebook, Stock Twits, and Trading View account. All of them, Wilson's Finance Mind. Twitter, I shortened it down just to help a little bit. So join us, subscribe, and remember to come to wilsonsfinancemind.com. Thank you.